Good morning, everyone. I'm David Talbot, Managing Director and Head of Research here at Red Cloud Securities. Our next presenter today is Keith Bowes. He's Managing Director of Lotus Resources. Now, Lotus is focused on its low capital restart of the past-producing Calaco mine in Malawi. So, Keith, why don't we give you 15 minutes and then we'll come back for a 5-minute Q&A at the end of the session. Everybody, hit those buttons and get your questions in.
Excellent, David. Thank you very much for that introduction. So, welcome, everyone. As David has mentioned, my name is Keith Bowes and I'm the Managing Director of Lotus Resources. And Lotus Resources acquired the Calaco uranium project from Paladin back in early 2020. And when we have a look at the project, what are the things that attract us or attracted us to Calaco? Well, I suppose, first of all, when we look at it, it is a past producer. So it has a proven production history. It produced over 11 million pounds of uranium between 2009 and 2014. We also recognize there was a significant amount of money spent on infrastructure. We estimate Paladin spent in the order of around $200 million on building the plant. And what that means when we carry the project forward, obviously, is we have no intention of expanding the throughput or the production of the plant, but we would like to start it up at the existing 3 million pounds per annum. And because we're not doing any expansions or new builds, our cost to bring the asset back online is relatively low. Based on our scoping study that we announced to the market in 2020, we estimate around a $50 million capital restart required. We are currently in the process of a feasibility study, which we commenced in August of last year. That is well progressed at the moment, and we expect to be able to deliver the results of our feasibility study to the market in the middle of this year. One of the other things that we really liked about the asset when we were doing our original due diligence was the exploration upside. And we've been able to successfully increase our resource since the original acquisition, where the asset was sitting at around 27 million pounds. Our current resource at the moment is 46.3 million pounds. And we've grown that through a combination of both some exploration work at Calaco, but also a reassessment of the geological models and also an investigation or an assessment of the cutoff grades that have been used for the plant as well. Also, from an exploration side, we've had some success in acquiring new tenements within Malawi. We acquired a tenement called Livingstonia late last year. We sent our drill rigs down there immediately afterwards to do some drilling, and we've just completed a drill program there as well. The results or the samples are on their way down to South Africa at the moment for assaying, and we hope to be able to announce to the market by the end of this month some of the results from our Livingstonia tenements as well. So one of the things that I just want to quickly talk about with regard to Calaco, in our opinion, it is a significantly undervalued asset. And the reason why we say that is that, in our opinion, when you look at the existing uranium cycle, where the uranium cycle is at the moment, we think we're at the start of a super cycle. And it's the companies at this stage that have assets that are on care and maintenance and can be brought back online relatively quickly that we think are the ones that are going to be able to take the most advantage from the start of this new super cycle. So when we have a look around the globe at the moment and we consider the companies that currently have assets on care and maintenance, and I'm only really looking at public companies at the moment, not really any of the state-owned companies, but really there's only 5 or 6 companies out there that currently have assets on care and maintenance. You have Cameco, of course, with their McArthur River and Rabbit Lake. You have Paladin with their Langer Heinrich operation. You have ourselves, Lotus, with our Calaco. Energy Fuels, Boss Resources, and Peninsula Energy also make up that mix as well. But what I think is probably not very well known in the market at all is that all of these assets out there at the moment that are on care and maintenance, the Calaco asset is the 4th largest producing asset currently on care and maintenance. So obviously McArthur River and Rabbit Lake are bigger than Calaco at the moment, as is Langer Heinrich with their asset over in Namibia. But Calaco's 3 million pound per annum production rate is the 4th largest asset currently on care and maintenance. And we don't think that's been well recognized in the market. And if you compare our market cap against these other peers at this stage, you'll see our market cap sits around the 220 US million at the moment, compared to Paladin around 1.4, Energy Fuels around $1 billion, and Boston Peninsula sitting around the 400 and 120 as well. So we're hopefully through exercises such as this, we can start to get the story out about Calaco, just what a profitable asset it could be moving into the future, and hopefully be able to drive that market capitalization up. So just talking specifically about the project in itself. So as we said, Calaco is a low capital, a quick restart uranium asset. We have all the existing infrastructure in place. So we have a processing facility that is capable of processing about 1.4 to 1.5 million tons per annum. This gives us about a 3 million pound per annum production rate, assuming a grade of around 1,100 to 1,200 ppm. But I think what is also important to note is that when the asset went into care and maintenance in 2014, there has been some technology developments since then that we think are applicable to the Calaco project or to the Calaco asset. And ore sorting is one of those, which I'll talk a little bit more about in subsequent slides. We also have all of our licenses in place. So we had our mining license was renewed for another 15 years in September of last year. We have our environmental license in place as well, and we're busy negotiating our mine development agreements and our community development agreements as well. And as I've also mentioned, there is significant exploration upside with multiple near mine targets that we can follow up on. So when you look at our pathway to recommence production at Calaco, where are we at the moment? Well, we've completed our exploration work around the Calaco resource, and we're doing some more exploration work at some of our other tenements. But we announced to the market our new resource upgrade, and that was the 46.3 million pounds that I've spoken about. We've started our DFS, so our feasibility study is well advanced at this stage. We're using the new mineral resource estimate that we've just announced as the basis for that feasibility study. Our mining consultants have been out and got mining rates from various contractors that we can use. They're currently busy with the Whittle pit optimizations. We've had our engineers come to site to do the inspection of the existing plant, just to confirm that $50 million capital for the restart. And we're busy with a number of discussions as well with potential off-takers in North America. We're participating at the moment in some of the requests for proposals, but I think what we really want to do is to be able to complete our feasibility study such that we can provide more confidence to these utilities when we do go into negotiations about our costs and about our production profiles. Now, based on the current schedule where we are at the moment, we will be able to finish our feasibility study by the middle of the year. We would then move from there into firming up some of these offtake negotiations we've had, as well as some financing discussions. And we would be able to make a final investment decision, we believe, by the end of this year. However, that final investment decision will depend upon the uranium price that occurs at that stage. So we're looking for an appropriate uranium price before we make the decision. After we've made the decision to restart the asset back up again, we're looking at about a 12 to 15 month period for us to refurbish the plant. So based on making that FID at the end of this year, we could be up and producing uranium by the first quarter of 2024, and that's the calendar year, and being able to deliver product into the market in that second quarter. I'll just talk a little bit about some of the work that we've been doing with regards to our technical studies and these technology advances. So we did a scoping study, as I've mentioned, which we announced to the market, and that scoping study was really based on the assumptions that we would operate the plant in exactly the same way that Paladin did. And by doing that, we were able to use a lot of the real plant data in our scoping study, and we were also able to use our scoping study to really define what were the cost drivers and the value drivers for the project. And based on that, we identified 4 areas that we think can add significant value to the project. Ore sorting, which gives us the opportunity to increase the grade of the material being fed into the plant, is one key area. The second one is looking at power. So at the moment, the plant itself is run off diesel gensets. We're looking at options to connect to the national grid. We're looking at options to take power off this acid plant through a steam turbine. And we're also looking at some renewable energy options such as solar. So there's a potential benefits in terms of reducing our overall power costs through those studies. We know acid is very, very important and is a key cost driver for the project. And we're looking at some acid recovery and better utilization of acid within the system as well to help us drive down our costs. And then the last one we're looking at as well as tailings dams and how we could potentially use the abandoned pit after we finish mining for the disposal of tailings. So all four of those areas are well advanced at this stage, and the results from all of those will be used in our feasibility study, which, as I've said, will be announced to the market in the middle of this year. So that's just a little bit on the rare earths as well. So as I mentioned, we've completed all of our work up at Calaco, but have actually moved the drill rig down to Livingstonia, where we've now completed our drilling. And then the drill has just moved up to Chilumba, which is the target there up on the top right-hand side. We've got about 1,200 to 1,500 meters of drilling planned over there, more of an exploratory nature. But the geologists, when they had a look at that regional area, are telling me that it looks very, very similar to the Livingstonia mineralization and geology. So we're looking to get some really good results out of Chilumba that we can announce to the market as well later on this year. Just one last thing I want to talk about is ESG. ESG is very, very important to us. Not only do we want to make sure that we're welcome in Malawi, we're also able to uplift the local communities and maintain our social license to operate. But we also realize that ESG has a value for us in terms of our negotiations. And those would be negotiations either with potential utilities, where they're looking to do some off-market agreements, maybe trying to build up their own ESG profile. But we also recognize when we go to the banks and when we go to the finances, having a very, very strong ESG profile is going to support our negotiations with the various debt providers or even with the equity groups as well. As such, the company has actually announced its inaugural sustainability report. It was released to the market in November, December last year. And on the back of that, we're continuing with our environmental work and with our social work. As I did mention in the agreement section, we are busy negotiating a community development agreement. We expect to get that completed within the next month or two and be able to announce that to the market as well. So really just to summarize then where Lotus is, so we believe we're very well positioned for the next uranium cycle. As I've mentioned, we have 11 million pounds of proven historical production. We are in a very strong cash position at the moment. We have circa $27 million, of which a portion of that is restricted. Now, what I mean by that is it is associated with the environmental surety bond we have in place in the Malawian banks. But as of December, we have got $14 million available to us. And that $14 million is enough to see us through the completion of our feasibility study, the completion of our exploration work. It covers our care and maintenance costs for this year. It also covers our corporate overheads as well. So we're cashed up into the early 2023 at this stage. As I hope I've been able to demonstrate through this presentation, there is still significant valuation upside for Lotus, and that's both through a combination of where we see ourselves perhaps being undervalued compared to our peers. But I do think that all the technology and exploration work that we've been doing at the moment, which will come out through the feasibility study, will also add significant value to our shareholders as well. We have a very experienced board and management team in place. I myself have got a lot of Southern African experience. I was born in Zimbabwe and I've done a number of projects in Southern Africa. I've been involved in the uranium space for a number of years as well. And we have equally strong people on the board as well. And then really we've got some very, very strong news flow coming through over the next couple of months. Those cover things such as the exploration I've spoken about, the resource upgrade that we've done, and of course our definitive feasibility study, which is planned for the middle of this year, leading into our financial or our financing discussions and also our offtake agreement as well. So David, that's the end of the presentation. I'm happy to take any questions that anybody has.
Okay, great. Thank you very much, Keith. So yeah, let's get on to the questions here. And if anybody has some more, just feel free to hit the button and we'll get to as many as we can. So Keith, you mentioned the definitive feasibility studies coming out mid-year. And could you perhaps speak to some of those cost savings you expect? You know, how much work have you done on ore sorting or acid consumption or recycling, things like that?
Yeah, so just to give you a little bit of a heads up in terms of where I think we're going to go. So within the scoping study that we announced, we had a C1 cash cost of around $33 per pound, which was based on the base case scenario. And as I said, when we did all of these studies and picked these various areas of work we wanted to do, first of all, if we speak about power, power accounts for about 15% of our C1 costs. And we think we can more or less halve our power costs by connecting to the national grid, having a look at the steam turbine, and also having a look at the solar options as well. So theoretically, there's a 5 to 7% reduction we can get in our C1 cost just based on the power. The ore sorting is also a very, very strong driver in terms of reducing our costs. So because we're able to maintain a higher grade or feed a higher grade into the plant over a longer period of time and maintain this 2.6 to maybe 3 million pound per annum production rate over an extended period of time, that of course dilutes down our fixed costs, which contribute to reducing our C1 costs as well. So we see that as being a key driver for it. We also recognize, and we haven't quite quantified this yet as well, but the acid consumption of the concentrate produced from the ore sorter looks like it could be less than the acid consumption from the original ore. And that also helps us a lot because we know acid is a key component of our C1 costs as well. Acid recovery is also important, as we spoke about, through this reusing acid through the nanofiltration plant. We expect to see some benefits from that as well. My estimate is that the feasibility study, when it comes out, will have approximately a 10 to 15% reduction in the C1 costs compared to what we had in the scoping study.
Okay, so you mentioned you don't really want to increase production too much past the 3 million pounds, but if you're using ore sorting, would you be able to improve on those past production rates fairly easily? You know, is there perhaps a plant limitation in the back end that we need to worry about a bit?
Yeah, so there's effectively 3 constraints on the plant. At the front end of the circuit, when you're looking at the mill, the maximum ore throughput is 1.5 million tons per annum. When you look at the back end of the circuit and you look at like the resin in pulp, or you look at the elution and the drying and packaging facility, that constraint is about 3 million pounds or a little bit over. So if we wanted to push our production rate above 3 million pounds, it would mean us spending quite a bit of capital in terms of expanding our resin and pulp circuit, expanding our elution circuit, and potentially expanding our drying and packaging facility as well. So we think that 3 million pounds, especially with the size of our current resource, gives us sort of a 10 to 11 year life of mine. And we think that is more or less a sweet spot for us to be able to operate in.
Okay, no, thank you for that. So as you're moving towards production here, do you expect to expand your executive or technical teams over the next year or so?
Yes, so we recognize that we have to start building the team up. And one of the first things we did this year is we've actually appointed a new CFO, Michael Bald, who has a lot of production experience. So he comes from a number of, or has been the CFO of a number of operating assets. And we've brought him in here to help us develop our systems, develop our processes, so we can start to move away from being an exploration developer into an operator. So he's been a key person in terms of us bringing that forward. There are additional technical people that we're looking to bring in. We obviously need to bring in probably like a project manager or so to look after the refurbishment for us. Whether that person then transitions into like the general manager or something like that on site, we're not sure at the moment, but we certainly be looking for someone like that. And we're also having some discussions at the moment about whether we should be trying to appoint someone else to the board as well. And that's something that's just started now, and hopefully we'll be able to make an announcement to the market in the next month or two. But we certainly recognize the need to grow the team, and we've started to focus on that now.
Okay, great. Thank you, Keith. We have about a minute left. So, my next question here, production is targeted for early calendar 2024. Is there a scenario that you might be able to see that moved up? What uranium prices might you need? Would you be seeking higher priced offtakes, long-term contracts?
Yeah, I think in terms of having like a logical sequence of steps to starting production. So we finish a feasibility study, we then, really get into the negotiations around offtake, and then that leads into our debt negotiations as well, and recognizing the 12 to 15 month period required to refurbish the plant. That points us toward this 2024 startup. However, if we were to see a really big increase in the uranium price and we were asked to pull things forward, I think there is an opportunity to do that. And I think that's going to be perhaps by looking at some of the longer lead items that maybe we need to purchase for the refurbishment. Now, it's not big things we need to buy. We're talking maybe like acid pumps or something like that. Maybe a couple of transformers that we need to replace or something like that, that maybe have the sort of, 30-week lead time or something like that. if we were confident, we could actually place the orders for those this year, which would then allow them to be delivered in perhaps the first half of next year. And that might allow us to pull back the start date. But I still think we wouldn't be able to start up much earlier than end of third quarter or start of fourth quarter next year. I think that's sort of the timing, even at best, under the best case scenario, we would be able to achieve.
Perfect. Okay, well, thank you very much for joining us today, Keith. Thank you, everybody in the audience, for the questions. Up next, we have Canada Nickel on stream 1. We have Bradhead Lithium on stream 2. Thank you very much.